Welcome to this flight of the Retail Pilot. I'm Ken Pilot, former CEO and current brand advisor, investor, and board member. I'm thrilled to share with you some of the insights from retail's leaders and legends, as well as my perspective on retail today. This podcast is sponsored by the following. Want to drive more traffic and conversions on your e-commerce site? Brands that use video see 41% more traffic from search engines. And that's just the start. Meet Firework, the leader in AI-powered video commerce. Trusted by brands like L'Oreal and Unilever, Firework turns any page into an immersive, shoppable experience. From pre-recorded long-form content to short-form and everything in between. With Firework, you can easily integrate social media videos into your product pages and run pre-recorded digital showrooms with shoppable content. Plus, Firework offers AI-powered virtual assistants to personalize shopper experience and drive higher conversion. That's why I'm an investor and advisor. Learn more at firework.com. On today's flight of the Retail Pilot, I am fortunate to be joined by my friend and venture investing guru, Scott Friend. Scott is a partner at Bain Capital Ventures, where he invests exclusively in the commerce ecosystem with a focus on commerce and marketing technologies and next-gen retail, drawing on his extensive experience as a founder in this sector, having built and sold ProfitLogic, a pioneer in merchandising analytics, acquired by Oracle in 2005. Scott brings operational expertise and a founder-first ethos to his investment approach. Since joining Bain Capital Ventures in 2006, he's been a trusted advisor to entrepreneurs at all stages, backing notable commerce and marketing tech companies such as Attentive, Miracle, HookLogic, Flow.io, Archive Resale, and most recently, Vermont and ShopMy, as well as next-gen retail disruptors, Rent the Runway, Jet.com, and Wonder. Recognized as an Ernst & Young Entrepreneur of the Year and honored for his influence in retail technology, Scott holds a BA in engineering, economics from Brown University, and an MBA from Harvard Business School. Outside of work, he's passionate about family, literature, outdoor activities, and supporting educational causes. Scott, welcome to the Retail Pilot. Scott, tell us how you got into investing. Give us a little bit of your background and how you ended up where you are today.
Kind of serendipity, I would say. I hadn't really thought a ton about being an investor early in my career. I was really passionate about the retail ecosystem. I was very fortunate to stumble into the technological founder of what became ProfitLogic. And we built that business up over 7 or 8 years. And I had been kind of in and around the retail world in my first job out of college. I worked for IBM in sales, and all of my customers were major retailers. This was back in Chicago, in the era of Carson Pirie Scott and Marshall Fields and big department stores. And so I kind of loved commerce and had this great experience building ProfitLogic. We sold it to Oracle. I spent a year in their retail industry group. And I was thinking about what to do next at that point, and actually was really motivated to start another company in the commerce ecosystem. And I hadn't quite landed on the idea. And the folks at Bain Capital, who had been my largest investor at ProfitLogic, asked me if I wanted to join as a venture partner, which was a little bit of code for, come here for a year, figure out if you like investing, figure out if you want to start something else. We'll figure out if we like you. And, my calculation at the time was I was in Boston. I wasn't going to move. Bain Capital had an incredible reputation as an investment firm across a variety of asset classes here in the Boston area in particular, where it was headquartered. And I thought, if I'm going to learn to be an investor, what a great place to go learn. And even if I'm terrible at venture investing, maybe I can at least add some value in other parts of the business and spend a few years. And so that started, the process. That was 20 years ago. And I'm still here, still figuring it out.
Tell us, how has Bain Capital Ventures evolved over the 20 years that you've been a member of the team?
Yeah, quite a bit. I mean, when I got here 20 years ago, the whole venture team was in Boston, and most of the funds inside Bain Capital were headquartered in Boston. There was a presence in Europe and a presence in Asia, but it was a very Boston and US-centric business overall. And as I said, for venture, we were all in Boston. And the implication of that is it's really hard to be the first investor in early stage opportunities in New York or the West Coast when you're sitting in Boston. And so we tried, and we had some interesting successes in the region, and a few things we did that were Series B or Series C investments a little bit later, that were on the coast. But it was no great surprise that if you wanted to be an early investor in the biggest opportunities, you had to have your team on the ground in the geos where most of the opportunities are built. And, a disproportionate number of the biggest outcomes are built in California, and second place is New York, and third place is Boston, and a few other markets. So that started the process, which is not so atypical of many, many venture firms, of migrating west. One of my partners, Ajay Agarwal, left us here in Boston and moved to the West Coast with his family, started building on our business there. Roll the clock forward another 15 years. We now have half our team in California and half in New York. And I'm kind of lonely here in Boston today.
Tell us a little bit more about the type of deals BCV is looking at and investing in.
I mean, broadly for BCV, we do everything from super early seed stage investments to what we call growth, which is later stage, high velocity companies with, 10, 20, 30 million in revenue, where we might invest $50 to $100 million. So we have a big fund. We do everything from super early to that growth stage. And we do it very intentionally across a set of sectors where we feel like we have deep domain expertise. In my case, that's commerce. We have a team that focuses on fintech. We have a team that focuses on infrastructure software. We have a team that focuses on AI applications. We have a team that focuses on healthcare IT. And each of these areas, we have the benefit of leveraging the broader Bain Capital that has expertise and resources and reach in those same industries. So I think one of the kind of distinguishing factors that's really a huge asset for us as venture investors at Bain Capital Ventures is that we can dig into the reach and the expertise of our colleagues, whether it's in private equity focused on industrials, or our hedge funds who's got investments in commerce, or it's our life sciences fund that has expertise in biotech.
When you say early stage seed, Scott, are you looking at anything that's pre-revenue, or does it all have to have revenue?
Yeah, much of it is pre-revenue. And again, it's pretty barbelled in our case. A lot is very early and a lot is much later stage. There's a handful in between, but we back plenty of founders that are, in the first iteration of their idea, recognizing that it's likely to evolve quite a bit this time.
Scott, I want to talk a little bit about what are the core principles, the guide that you use when making investment decisions, especially when evaluating early stage technology companies.
Boy, I guess let's see what comes to mind. Definitely, and I'd say this is true of our group overall, very founder first in my thinking, particularly at early stage, but I'd say probably at all stages. We try to think about whether the founder is bringing kind of a unique insight to the area that they're playing in. Do they have some unfair advantage or real right to win in the arena they're playing in? And really just from a personal characteristic standpoint, are they spiky, edgy, kind of outlier type people? That's, I think most of the most successful founders that we've had the benefit to work with have kind of had those outlier characteristics. So those are the things we look.
Are you looking for founders who have already had an exit? Is that a prerequisite or not necessarily?
Definitely not. I mean, I have backed some founders that have had exits before. I've backed some founders that I've had exits with. Those are easy because you have a working relationship and you've seen them in action. But I would say 90% of the founders we back are doing it for the first time.
And how would you say your experience as a founder and operator has shaped your approach as an investor at Bain?
I mean, I think it has a ton. No different than anyone's experience, shapes no different than your experience as an operator in retail has shaped your thinking around opportunities, I think, very successfully. I've lived some of the battles that these folks are living. I've seen what it takes, both the good, the bad, and the ugly, to build a business from the ground up. And, I guess I look for folks that have what feels like the grit associated with, or the passion associated with, like, doing these unnatural acts and sticking with something despite the fact that on a risk-adjusted basis that might be insane, because they just cannot do it. I meet with a lot of students at business schools and coming out of college who are interested in starting companies, and they're debating whether, to take their offer from McKinsey or start a business. And I often say, look, if you wake up at night and you can't stop thinking about it, if you can't not do it, then you should do it. But if that's not quite how you feel, then I wouldn't do it. I would listen to your parents and go to McKinsey. And I think that feeling that I know I had when I was a founder, I look for in other founders, and that resonates with me. The other thing I'd say, which is a little more true when companies are a bit further along, maybe they've raised a seed round and they have a little traction. I really love visiting them, their office, their environment, wherever their work environment is, versus just having them come to my office or meet on Zoom. Because like you get a real feel for the vibe of the place and the culture and the nature of the people when you go see their home, essentially. And so that's, I guess maybe something that I say to some of my younger colleagues when we leave these meetings, if I'm going to have another meeting and think about investing here, I want to walk away feeling like I wanted to work there. Like the best opportunities, they don't all work, but the ones that I've had the most fun investing in, like literally I've left their office and I've been like, wow, I wish I was working at that company. And that's the vibe I love.
It's funny you say that. I'm exactly the same way when I look at early stage, and I've been doing this now for 11 years. I always want to meet them in their office. I want to see where they work, who they're interacting with, the kind of, you can tell their leadership presence, how people feel about them. There's the intangible that you can pick up only when you're in person. And I never want to not have that opportunity before investing, getting behind, or advising a company. So I totally agree. When you think about the founders that you've invested in and you've had a lot of success stories, it's a tougher question. Is there one team that just stands apart from the rest? Who's your favorite kid?
Right. It's a hard one. Well, I'll say two things, because there's a small handful that have been so unbelievably successful that at least in the world of revisionist history, it's hard to look back and not say, wow, they're incredible. There are some attributes of the most talented founders and the most successful ones that I do find that are common. And these are hard things to assess on the way in, but you often see them in the process. And then I will answer your question, I promise. But I'd say the way I characterize those attributes are that these most successful founders I've worked with have this combination of the ability to sell the dream in this persuasive way at like 30,000 feet, like this real reality distortion chamber type capability, but it's not just the salesmanship, it's coupled with this incredible knowledge and insight of the core economics of their business. I think I'll give you a couple examples. I think about Marc, who started Quidzy and then Jet.com and then Wonder, and Jen Hyman, who started Rent the Runway. And these are people who are as good as anyone I've ever met at pitching their company and selling the dream of what could be multi-billion-dollar businesses. But part of what makes them so good at pitching it is that when you ask them a question, they can dive down into the minute detail of how the business operates. I mean, Jen understands the economics of that fulfillment center better than anyone in the company today, with thousands of people working. Marc, for sure, understands the unit economics of his stores at a level of precision and with a level of insight that I'm not sure anyone else in that business has. And there are a lot of talented people. So it's this combination of really envisioning a big, kind of hard to imagine future in a compelling way and grounding it in the economics and realities of how the business is going to run.
So that would be Marc, and Jen would be a portion of that answer, but a good answer.
Yeah, they're in that answer. The founders of Attentive Mobile, Brian Long and Andrew Jones, similar. I would say, the founders of Miracle, Philippe and Adrian, similar. Like I also find, and I live this, so I'm sort of biased toward this, not true in Marc's case, but many of these great founders are founding teams, not individuals. And there's this incredible, I'm sure you've seen this, Ken, in your career, there's sort of this inside-outside split often. One may be very focused on building the market presence and early customers and customer relationships, and the other is really deep in product. And I find that sort of combo incredibly powerful, partly because I had it in building my own business, and I think it's super rare that someone can do both at an exceptional level, but often you find teams that have both.
Scott, complete the next sentence. The next big bet BCV will make will be in?
Can I edit it to say the next big bet in commerce?
Okay, you can. You're the guest.
because there's lots of other stuff we do, and I'm not sure what those bets will be.
I can even venture a guess that I know. I bet it starts with an A.
Oh, I'm not sure I follow.
Only because you and I connected, we were at NRF, and you were like on a mission to find this.
Oh, sure. Like an AI related thing.
Well, I think you were looking for agentic AI. That's what you're all over that.
Agentic commerce tools. Yeah, I am for sure. But I'll tell you what I was going to say, Ken. To me, the next big thing we'll do in commerce, like really big thing, will be a completely re-envisioned commerce platform that is AI native, that allows any maker of any type, big or small, to run their business out of the box. And there are lots of things today that feel a bit like running your business out of the box. Shopify is that in many respects. And there are marketing tools that are that in some respects. But no one has yet put all the pieces together so that I can just be a maker of little yellow balls. And all I have to worry about is making yellow balls. And the rest is done for me. The website, the content, the marketing, the channels in which I spend that marketing, the analysis of that marketing to prove it's useful, the customer success teams, all of it should be out of the box. I think that's going to happen. I'm increasingly blown away by the capabilities that I see the companies we've backed and others building, leveraging AI. And I think we're entering a world where makers of all types are going to have a dream scenario where all of the drudge associated with running their business can be done on that.
It's interesting. I'm seeing maybe part of that and a little bit differently, but starting with search and how search is really upending e-commerce as we know it. And so much can happen with your journey outside of your traditional e-commerce site. I mean, whether you're on Perplexity or you're on ChatGPT, you can really begin to shop completely outside of a site and complete the transaction without never appearing to go into the site. So I think that upending e-commerce as we know it today will happen. I don't know what a site will look like or why you will need one.
Right.
And
I agree to a point. I think it's a little like shopping in the physical world in that I think we've all proven as consumers that there are a lot of physical stores that don't need to exist anymore. And as a result, we're seeing them shut down. But there are plenty of physical shopping experiences that we all still love. And we go to those malls and those stores. Those might be outdoor lifestyle centers now versus indoor malls. And they might be more experiential type of retail environments. But there are shopping experiences and shopping missions for which we still enjoy doing them ourselves versus pressing a button. I think the same will be true on the web. I think there's going to be plenty of shopping missions that an agent working on our behalf will go do for us. Like, it's time to get new sports gear for the kids for fall. Like, man, my agent to know the kids' sizes and what sticks and gloves and bats and balls they need and how to return and resale the old stuff and get new stuff. And I don't want to worry about that. Those things are going to be done for us. But there are certain experiential sites that are fun to go click on and see the images and watch the videos and experience something new. And I think those will continue to exist.
And now a quick word from our sponsor. Looking for a 3PL that's truly next level? Cart.com is a 3PL on steroids with nationwide distribution centers and the most advanced AI-driven software solutions from WMS and OMS to TMS, all designed to streamline your entire delivery process. With Cart.com, you get a fully integrated commerce platform that unifies your operations, data, and customer experience all in one place. Their platform combines physical distribution with cutting-edge AI, empowering retailers to scale faster and more efficiently. Whether you're D2C, B2B, or omnichannel, Cart.com connects your tech stack, simplifies your logistics, and powers your growth. From click to customer, enabling distribution for Janie and Jack, Portland Leather Goods, Tom's, and many more. Cart.com. And we're back. Analytic rigor. I think this probably is right in your sweet spot, but how has that been a key differentiator in your investments?
That's a good question. I mean, I don't know how unique I am on this front. Kind of data and analytics are sort of fundamental to, I would say any good business. It's hard to think of a founder who is building a great company who isn't rigorous and analytic in nature in how they instrument and sort of think about their business. But certainly from the early days of my work at BCV, I probably brought with me a lot of the philosophical approaches from ProfitLogic, which was an analytics-oriented company. And so I looked for founders and businesses that had analytic DNA from the ground up. I think that kind of bias toward analytic rigor in a company is not something you could sprinkle on later. I think it's something that's got to be in the founding team and founding DNA. And so I love the example of Rent the Runway because, on the surface, this was, two women starting a dress rental company. But under the covers, every single thing they built was rooted in data and precision on how to make the economics of business work. Their 8th or 9th employee was one of the chief scientists from my former company, ProfitLogic, and then Oracle, who became chief analytic officer at Rent the Runway when they were less than 10 people. And then, kind of architecting most of the core systems in that business. So I think many, many companies are sort of built from the ground up that way.
When you're looking at companies, especially today with AI really dominating the landscape of opportunity, how do you assess or decide that this is a great company that has a moat or maybe some protection around it versus an AI platform that's going to be up against many other platforms just like it? Does that keep you up at night? It does for me.
Yeah, I think it's a good question, and I don't think any of us know the answer yet. And I think we don't know the answer because we don't know the breadth of aspiration of foundation model companies. It seems plausible that they will at some point move beyond better, faster, cheaper models to applications that leverage those models. It's no different than Oracle having moved on from relational database to all sorts of applications that leverage that database, because that's where lots of the money is. But for the foreseeable future, the foundation model companies seem to be pursuing general artificial intelligence and better, smarter models at sort of all costs. And that trickles down to great models that we can use for commercial purposes, which is terrific. And so I think the basis of competition for startups and the basis for differentiation and a moat isn't a lot different than it's been in prior generations. It's rooted in the UI, the workflow, the capabilities that leverage the model as opposed to the models themselves. We're investors in a company called Decagon, which is AI-based customer service, great application for AI. And there's another terrific company called Sierra, which is, big competitor, similar approach. Why will one win versus another? Well, they may both win. They seem to both be doing super well. But at the end of the day, the AI in the guts of these companies is becoming a commodity. The integration to other systems in the enterprise and the workflow associated with customer service and the insights spitting out from the systems that helps these companies run their business better, that's going to be the differentiation. The other thing, which is same as it's ever been, is the vendor's customer service. Like, how good are they at working with the company, with the enterprise, and helping them be successful? Like the same old stuff that we were doing, 20 years ago and 10 years ago, I think still matters.
It's interesting. Working with companies that are early stage, I find the sale, though sometimes that can be painstaking, to be easier than getting the company to stay on the platform, getting adoption across the company, and avoiding churn. And I'm constantly working with founders to make sure that we're putting enough in customer service and customer success to not lose that account.
Well, you and I are cut from the same cloth, Ken, for right or wrong. If you polled any of the founders that I currently work with or have over the last 20 years, and you say, well, what is the one thing that Scott always says in board meetings? It's probably a broken record to most of them at this point. It's that you cannot overspend on customer success. It's not possible. It's particularly when your customers are in the commerce ecosystem, where for better or for worse, everybody knows everybody. When you make people wildly successful with your software, they tell everybody else. And it's a virtuous cycle. And when you screw one up or ignore it or don't make them successful and they churn, candidly, there's like not enough venture money in the world to dig you out of that hole. So I am all for over-investing in customer success, especially early in the life of the company.
And what are the metrics, Scott, that you're looking at for these companies in terms of when you're evaluating SaaS or commerce tech investments?
I'd say that the things that These are not going to be particularly insightful or controversial for folks, but the things that jump out at me that get me interested start with, and this is for companies that have some metrics, right? They're not just pure startup business plan. It starts with revenue momentum and customer happiness. Like if I see those two things, I'll give you a great example. ShopMy, this platform for brands to manage their influencer marketing, we just co-led a Series B there with another firm at the end of last year. And I had met the founder 6-9 months earlier, was really impressed, had stayed in touch, really enjoyed the interaction. And then I got a little glimpse at the data. And the company was growing last year from 4 million to 31 million. Well, that's not something you see every day. That's kind of eye-popping growth. And if you see that, you have to peel back the onion and start to understand something's going on here, what's going on. And so that's an extreme example where it's sort of obvious something's working. But I think in general, when you see revenue momentum and you see logo momentum, and then you make a few phone calls, this is why it's helpful to be deep in a sector. I can call you. I can call 15 other people that I know that run major brands and retailers and get a firsthand opinion of how these vendors are doing. And when you hear things like, this is game changing, we're switching way more of our budget to this thing now because it performs so much better. We couldn't live without this thing. Please don't tell them. Those kind of comments, those are the things we look for.
When you're working with the founders and you're talking to them about whether it's success from an advisory perspective or a board member perspective, what is it that you try to impress upon them most in addition to customer success? I mean, they have a lot going on. They're trying to build a business. They're trying to scale very quickly. They've got aggressive shareholders that are looking for large returns, and yet they're competing out there in a pretty tough world, trying to get the attention of CTOs or CDOs that probably are overwhelmed to begin with. How do you coach them for success? What are you telling them?
It feels like it's a bespoke answer in each case because each of these companies is so different. But the common threads, I would say, are, there has to be extreme focus on the value of the product. So that obviously links to customer happiness and customer success. But you really can't in this era. This is unlike the 20 years ago, 25 years ago, ProfitLogic enterprise software era, where you could fake a lot with professional services thrown in to make your software work. In this era, the customer expectation and the reality of software deployments are such that product has to work more or less out of the box, and it has to be able to demonstrate value quickly because there are way too many other players. Life's too short. Customers are too smart. They'll bake you off against other people very quickly. So number one, extreme focus on product and product value. And then number two, I really don't think there is an alternative to momentum. If companies I work with are debating whether to lean into spend when things are working or be more cautious because runway constraints, et cetera, buy more time. Of course, there are situations where you need to buy more time, but I would way rather a company pushes it closer to the edge on cash in the service of driving momentum than not, because the reality is the next investor or the acquirer or public market investor, they want to buy growth. They want to see momentum. Just because you're not burning so much, but you're going sideways, that's not so attractive to anybody.
Where and or when do you want to see profitability? Ideally, when do you think you should start getting some EBITDA out of the company?
I'd love to see some someday. Anywhere.
Any
of my companies, anywhere, ever, would be great. I would say the companies I work with that generate cash do it despite themselves, meaning that's not their goal. They just happen to be such efficient models that they are, even though they're growing really fast, they're very profitable, they're generating a lot of cash. But broadly, almost entirely across my portfolio, these are companies that burn money on purpose as they're growing. As they get bigger, those losses do need to narrow. You do need to show that when you're in the hundreds of millions of dollars, that there is a path to profitability. But look, if the market is big and the unit economics of the business are positive and capital is inexpensive, then you should use capital and grow. I think that's what most companies do.
How are the founders in the companies that you invest in reaching out to you? When do they reach out to you? And what is your involvement like with a founder, maybe outside of the board meeting?
Yeah, I'd say most of the involvement is outside the board. Board meetings serve a purpose that I think is important, but I'd say probably 90% of my interaction with the founders I work with is outside the context of the board meeting. They reach out all the time. You know this because you've done it. When you're an early investor, you tend to have kind of a special relationship with founders. And I think both professional and emotional one, and hopefully a nice personal one, because, part of what makes this job so fun is that you actually like the people, that you're working with. And so I'm kind of a 24/7, text me anytime, I'm available kind of guy on this front. I appreciated that when I was in their shoes. And I want to be the first phone call, candidly. Like, I love being the first phone call when something great happens, but I recognize what comes with that as being the first phone call when there's hard things to deal with.
Looking back, Scott, what investment or founder story taught you the most about risk and reward?
About risk and reward. I mean, the one that jumps out at me, I just told this story in a fireside chat at a big Bain Capital event with Marc. Back when Marc was building Jet, we had been in the seed round there and then led the A round. And the company was spending a lot of money, $50 million a quarter on marketing while they were growing the business. And it was growing really well, but we were running low on cash. Marc's a tremendous fundraiser, but the Series B fundraise was not going well because the unit economics of the business were upside down at the time. Gross margin was, on the verge of positive, but actually was even gross margin negative for a period of time. I mean, this was not in the early days an attractive business. It got attractive over time, but at that point, you could have been a skeptic. And I remember I was driving into my office at Bain Capital in Boston, and I called Marc and I asked him how the fundraise was going. And he said, yeah, less well than he had thought that he was hoping. And, we were getting close to the end of the runway. And I said, okay, Marc, so what's plan B? And he said, yeah, there's no plan B. And I remember as I thought about driving my car into the oncoming traffic on the Mass Pike and then thought the better of it, I'm like, wow, no plan B. Here we go. And when you ask him about that scenario, he says that, you know what? It didn't make sense to have a plan B. And it's back to this idea of if you're not growing, no one cares. And so in his mind, the only choice was to keep doing the things that he knew were positive for the business or were going to help it grow. And eventually he would raise money or not. But he was going to do the right things to grow the business one way or the other or die trying. And to his credit, he ultimately raised the round and, the rest is history.
So that was a startup that went from startup to exit fairly quickly.
Yeah.
Must have been your most successful investment to date.
I mean, it was fast. It was maybe 3 years or so from the seed round to when the company sold to Walmart, maybe 4. I can't remember exactly. But we've been very fortunate at Bain Capital. Attentive Mobile is a $500 million company. We were the A-round investor there. Miracle is a close to $200 million SaaS business. We were a little later there in the Series C. We're at the runway. We were literally the first dollars in the seed round, and that was worth $1.5 billion when it went public. Obviously, a less attractive valuation today, sadly, thanks to COVID and a lot of debt, but hopefully they'll figure that out over time. And so there's been a bunch of good examples where, we've been fortunate and these companies have made a lot of investors and a lot of people a lot of money and created a lot of jobs, and hopefully more to come.
Could you share with us your batting average? I mean, you hear rumors out there that venture firms realize maybe 1 out of 10 investments come to fruition. How would you summarize Bain Capital Ventures' success, your batting average there?
It's interesting. I would say as a venture firm, BCV, our batting average was too high historically. And that doesn't mean like, oh, gee, we're so good, everything works, right? It's not meant to be a humble brag thing. It means we probably weren't taking enough risk. And so in the early days of BCV, the first, 5, 6, 7 years I was here, we were doing more Series Bs than As. We were investing in businesses that we, kind of were good, not great, I would say, and had the potential to be good, not great. And as a result, we had a lot of singles and doubles. And it felt good in some ways because plenty of firms have wipeouts, but we didn't have any home runs. And as we all know in the venture business, this power law is real. Like the grand slams make all the difference and the rest, don't move the needle on a fund. And over time, as the center of gravity of the business has shifted more early stage, more West Coast, more frontier-oriented bets in many cases. I think we're taking way more risk in areas that we understand well. And the results have been more zeros and more big wins. So I'd say the batting average has come down, but the aggregate returns for the funds have gotten better and better with each vintage. Personally, probably a similar trajectory with a little bit of luck sprinkled in along the way. Meeting Marc when I did, very fortunate, and, making that investment despite my partners thinking it was insane, fortunate that, we got that done. But broadly, I'd say over the last 4 or 5 years, I've tried to lean into opportunities that really have outlier potential and could be big standalone companies if they work. And more of those are good.
Well, I had the good fortune of speaking with Emily Gittins on a podcast recently.
She's amazing.
And yeah, super, super impressed with what they're doing there. And I love the model. And right now, with all that's happening around tariffs, she couldn't be in a better place with her product. And companies should be running to her door. I don't know if there's a line up there, but I like to call them the circular economy as a service. And I love the way it plugs into companies and just really makes it very easy for companies to participate in recycling their own clothing. Scott, what advice would you give to your younger self?
You did preview that question for me, so I was thinking about it. And it's a hard one because I feel very fortunate to have the life I have with a family that's healthy and, who I enjoy being with and, just to be at this stage of life. But I think the thing I didn't get, and most people probably don't get when they're early in their career, is that I wish I understood earlier, is that it's really okay to not be great at everything and just to lean into the stuff that you really love and that you're best at. I was very frustrated when I joined Bain Capital and the first few years in venture, because I felt like I was, in a motivating way, was surrounded by more successful, brilliant people than I had ever been around in my life. And it was highly motivating, but I felt like a total imposter. I'm like, this is ridiculous. These people are so smart. They can invest in supply chain one day and biotech the next day and fintech the next day and commerce the next day. And like, boy, who's that smart? And it took me a long time to get comfortable with the fact that, knowing a lot about a kind of narrow part of the universe is actually okay. And it's kind of fun. And the more I've leaned into that over the years, the more enjoyment I've had in my job and in my life. And I think it's been a virtuous cycle from an investment.
Sitting here on May 20th and looking out at all that's happening in the world, and there's a lot from tariffs to the big, beautiful bill, whether or not that'll get passed, the House and Senate. How do you see the back half of 2025 shaping up for our retail community and also for the platforms with whom we work?
Yeah, good question. Well, it's back half of 2025 will happen. We know that. What will happen is the question. I am maybe too much. I'm an optimist. I feel the pain of the players in the ecosystem who are trying to source products overseas and sell them and make a living. And there are a lot of those small vendors and even big vendors that are in pain right now. And we see the ripple effect of that with all of our software companies that sell into that ecosystem. But it feels temporary to me. I think there will be more swings as more decisions are made around tariffs and around interest rates that, have some positive and some negative effects on people's psyches and potentially on the actual economics of their business. But each of these things, the sine wave seems to be dampening, I would say. And I expect it to kind of ultimately, reach more of a steady state as we get through the year. So I'm not optimistic about the Q4 being a fantastic Q4 for retail, because I think there's disruptions today in the supply chain that are going to have effects in 2 quarters. And that's unfortunate. But I'm very optimistic about kind of 2 to 3 years.
All right, Scott, last part of the podcast. We're going to go to rapid fire. First question. What's the investment that got away?
Oh, there are a ton. I would have to say I met John Foley in Peloton super early, and I really wish I had pushed to do that. I was in the midst of Rent the Runway building their first fulfillment center, and I'm like, man, these businesses where you have to move products around and you have physical merchandise and product, it's like putting a man on the moon. Like, life's too short. Give me some software. But, Foley was brilliant, and that business was worth $40 billion at one point. It would have been nice to have been there.
What is your go-to interview question to ask a founder?
Do you feel like a lucky person?
Favorite streamed show?
I really like this show, Drops of God. I don't know if you've seen it.
I have.
Yeah.
It's funny. Terry Lundgren on the podcast, that was his favorite show. And then I watched it. I loved it. Thought it was amazing.
Yeah. I love Drops of God. I love Three Body Problem. You saw that one, kind of a sci-fi thing. Very cool. And we watched this silly show with our kids called Only Murders in the Building. I don't know if you know it, with Martin Short and Steve Martin. Is fantastic.
Who would you most like to meet?
The Dalai Lama. I've been trying to learn about Buddhism. I'd like to meet him.
Okay. I don't think I would have picked that, but that's your call. If you had to double down on any of your investments, which one would it be?
I have a bunch I'd love to double down on right now, but, ShopMy, Wonder, Attentive, Archive, Fermat, you pick. I'd love to get more money in all of them.
Final question. Who do you think is the most impressive corporate CEO?
Two come to mind, one in tech, one in retail. I'd say in tech, Toby at Shopify. I'm constantly blown away by the innovation in that company and push to be great. I have a good friend who's a very senior person there, and I'm really blown away by what they continue to do. And then Doug McMillon at Walmart. What an incredible story personally, and what an incredible business they continue to build no matter what else happens in the universe.
And with that, we'll end this flight of the Retail Pilot. Scott, great to have you on board.
Thank you. Great to be here.
Thanks for tuning in to this week's flight of the Retail Pilot. And please give us a review on your favorite podcast platform.